Hi, we'll move into capital budgeting, and this topic talks about the different evaluating methods for capital projects, and this is a build up on NPV. Now we need to understand how to calculate the relevant cash flow for evaluating a capital project, which are of course the incremental after tax cash flow. We need to also look at the after tax salvage value of the impact of depreciation, impact of salvage value depreciation on cash flows. Once we have the cash flows down, it should be relatively easy to discount those and apply the proper techniques or decide between a replacement or an expansion or mutually exclusive project with different lives. Another concept that we'll look here is to how to value uh, these kind of projects where we have to replace one with the another, and also how various real options give managers flexibility with capital budgeting options. So this is more towards a build-up of NPV, and we'll also familiarize ourselves with the concepts of calculating income, economic profit, residual income, claim analysis, and so on. So let's delve into the topic. Okay, let's get into it. So the capital budgeting process is the process of identifying and evaluating capital project, that is projects where the cash flow to the firm will be received over a period of time that's longer than 1 year. Any corporate decision with an impact on future earning can be examined using this framework. Decisions about whether to pay a new machine, expand business in any geographical area, move the headquarters from one place to the other are examples of capital budgeting analysis. So there are few categories here, more specifically 6 categories. The first is replacement projects to maintain the business. The second is replacement project for cost reduction. Then we have expansion, new product or market development, mandatory projects, and other projects. And the principle of capital budget involves 5 key principles, and those principles are: the first one is decisions are based on cash flows, not on the accounting income. Cash flows are based on opportunity cost. The timing of the cash flows are important, and cash flows are analyzed on after tax basis. And financing costs are reflected in the project's required rate of return. So the relevant cash flows to consider becomes an integral part of the capital budgeting process, and they are called the incremental cash flow, the change in cash flow if the project is undertaken. Sunk costs are the costs that cannot be avoided even if the project is not undertaken. Since these costs are not affected by the accept reject decision, they should not be included in the analysis. An example of sunk cost is consulting fee paid to a marketing research firm to estimate demand of a new product prior to a decision on the process. Externalities are the effect which happens after we accept a project and how it will affect the other cash flows. Primary one is negative externality called cannibalization, which occurs when a new project takes sales from an existing product. When considering externalities, the full impact of the new product should be taken into account. An example of cannibalization is when the soft drink company introduces a diet version of the existing beverage. The analyst should subtract the loss of the existing beverage from the expected new sales of the diet. And similarly, there could be like positive externalities as well that would increase. So let's look at the first topic here: modified accelerated cost recovery system. The choice of depreciation method has an important implication for after tax cash flows of capital project. Most countries specify which depreciation methods are acceptable for use of tax purposes. In US, most companies use straight line depreciation for financial reporting and modified accelerated cost recovery system for tax purposes. For capital budgeting purposes, we should use the same depreciation method used for tax reporting, since capital budgeting analysis is based on after tax cash flow and not accounting income. Under MACR, assets are classified into 3, 5, 7 or 10-year classes, and for each year depreciation is determined by the applicable recovery percentage system, which is something like 33%, 20%, 14% and 10%. So for a 3-year horizon, the depreciation would look like 33, 45, 15 and 7. So if we look closely, It is an accelerated method. So by acceleration I mean that in the first year it would be fast, then it would slow down, and it will slow down with the time. So it's something like 33%, 20%, 14%, 10%, and it would slow down with time. Uh, so it's like you add all of them and you should get 100, because you cannot get depreciation more than 100, so you can backlink that. So if it's like 33, 45, 15, 17, and if you add all of them, you will get the 100% depreciation that has already happened. For the 5 year it would be like 20, 32, 19, 12, 11, 6, 6. An interesting thing to note here is that in the first year depreciation is slow, then it accelerates, and then it comes down. So the half year convention under so when we move ahead, okay, so when we look at it, we have to understand the cash flows and the yearly cash flows of expansion and replacement capital projects, and evaluate how the choice of depreciation affects these cash flow. Generally, we can classify increment cash flows for capital projects as initial investment outlay, operating cash flow over time, and terminal year. So in all these type of questions we'll have three parts. So first is investing into something, the second is the cash flow that you will get over period of time, and the third is the final cash flow that you will get. So when we move ahead and when we look at the outlay, which is the initial investment outlay, it comes up with front cost associated with projects. Components are price, which includes shipping and installation, and investment in net working capital, or the change in working capital that you require to get into that project. So when we move ahead and when we look at the formula, it should be outlay is equal to FCINV plus NWCINV, which is the first cash that you are doing, the investment. Now the investment in NWC must be included with capital budgeting decision whenever firm undertakes a new project, product or service. In additional to an additional inventory is used to support the increased sale, and the decreased additional sales to increase the account receivable. The account payable and accrual probably also increase proportionally. The investment in net working capital is defined as difference between non-cash current assets and change in non-cash liabilities, that is those other than short-term debt. Cash is excluded because it is generally not assumed as an operating asset. So net working capital investment is non-cash current asset and non-debt current liabilities. If non-working capital investment is positive, additional finance is required and represent cash flow because cash must be used to fund the net investment current asset. If negative, the projects free up cash, creating a cash inflow. Note that the termination of project, the firm will expect to receive an end of project cash flow equal to net working capital change, where the need for additional working capital ends. Now we look at the second part, or understand the after-tax operating cash flow. The after-tax operating cash flow, or the incremental cash flow over the capital assets economic life of operating cash flows, are defined as sales minus cash operating cost minus depreciation, tax over that, and plus the depreciation. If you look at it, depreciation is not something that would be cash, so that money will get back. So in other ways, we are taking the depreciation tax sheet. So tax into depreciation. If you look at it, if we buy something, we are going to expense it out. So when we buy something, we buy it from the net income that was already taxed. So we'll get the depreciation sheet. So all the and the other way to take this depreciation shield as tax into depreciation. Although depreciation is a non-cash operating expense, it is important part of determining whether the cash flow, because it reflects the amount of tax paid by firm. We can account for depreciation either by adding it back to the net income from the project as the first cash flow formula, or by adding tax caused by depreciation, which is the second formula. In general, a higher depreciation expense will result in greater tax saving and higher cash flows. This means that accelerated depreciation will create higher after tax flow for the projects earlier as compared to straight line method, resulting in higher net present value for the project. And this is quite interesting because depreciation will actually change in the NPV. The terminal year after tax flow operating, and which is the end of year, at the end of the asset life, there are certain cash inflows that occur. These are after tax salvage value and return of net working capital. So that's pre-cash proceeds from the sale of final fixed capital plus net working capital change plus T into the profit that we get and we subtract the tax. So in other words, the profit that we'll book is higher the amount of book value. We'll pay a tax on that, reduce that amount from the cash that we got by actual selling, and get back the net working capital. So this is how. Now an expansion project is an investment in a new asset to increase both the size and earning of the business. Now replacement project analysis. A replacement project analysis occurs when a firm must decide whether to replace an existing asset with a newer or a better asset. There are two key differences in the analysis of replacement project versus expansion. In replacement project, we have to reflect the sale of old asset in the calculation of the initial outlay. So it's like the money that you spend, FCINV plus NWCINV minus salvage value plus tax into salvage minus the book value. Now cash flow for incremental operating cash flow from the new asset minus the cash flow from the old asset. So again we have to change the incremental thing. So delta CF is equal to delta S minus delta C 1 minus T plus delta DT. So replacement project is again where you will get the deltas. The idea here remains that if you replace something, if you invest some money, then you have to just take care of the incremental part and not the actual part. Now suppose Marco wants to replace an existing printer with some other copier, then he had to take care of that incremental thing and not exactly. Now explain the effect of inflation on capital budgeting analysis, which is an interesting thing. We have around 5 points here that we want to stress. So analyzing nominal or real cash flows becomes important here. Changes in inflation affect profitability. Inflation reduces the tax saving from depreciation. Inflation decreases the value of payments to bondholders, and inflation may affect revenues and costs differently. Some interesting points here. So nominal cash flow reflect the impact of inflation, while real cash flow are adjusted downward and to remove inflation effects. Although either type of cash flow can be used in capital budgeting process, it is important to match the type of cash flow with discount rate. Nominal cash flow should be discounted at a nominal discount rate. Changes in inflation affect project profitability. If inflation is higher than expected, future projects are worth less and the value of project will be lower than expected. This opposite is also true. If inflation turns out to be lower than originally, the future cash flow will be worth more. And inflation reduces tax saving from depreciation. If inflation is higher than the expected, the firm's real asset paid to the government are effectively increased because the depreciation tax shield is less valuable. This is because the depreciation charge, which is based upon the assets purchase price, is less if we would have been recalculated at current prices. Inflation decreased the value of payment to the bondholders. Bondholders receive fixed payment which are effectively worth less if inflation increases. This means that higher than expected inflation shifts wealth to issuing firm at the bondholders' expense. Inflation may affect revenues and cost differently if prices of goods change at a different rate than the prices of inputs used to create goods. The firm after tax cash flow may be better or worse than expected. Evaluate capital projects and determine the optimal capital projects in situation where mutually exclusive projects with unequal life, or using either at least common multiple of average life approach or equivalent annual annuity approach and capital rationing. So when two projects are mutually exclusive, the firm may choose one project or the other, but not both. Mutually exclusive projects have different lines. The projects are expected to be replaced indefinitely as they wear out. An adjustment need to be made in decision making. The two approaches that we use here are the least common multiple of the life approach and the equivalent annuity approach. As the name suggests, least common multiple is that we find out we take a LCM of the life, and we create the equivalent annuity method in the same. So if we have got two projects, one is of 6 years, one is of 3 years, we will create both of the same time to calculate the NPV. So the NPV becomes the selecting criteria. Equivalent annuity approach. Equivalent annuity is a simple approach to evaluate mutually exclusive projects with different lives. EA project finds the sequence of annual payment. This is equal to project's NPV. The resulting calculation is annual payment that flows on for apples to apple comparison. So here we find out the annuity and find out which one is better. So we find out the installment or the annuity. For that we take the present value, future value we take 0, and n and 12. So n is the different thing that caused the problem initially, and the discount factor is the same, and whichever annuity is bigger, we believe that the higher the annuity, the project should be selected. The next topic here is capital rationing, and this topic, as the name suggests, is about selecting projects available to us based on various factors. So ideally firm would continue to invest in positive return NPV until the marginal return equals the marginal cost of capital. Should a firm has insufficient capital to do so, this must be the ratio of the capitals. So capital rationing is the allocation of fixed amount of capital among the set of available projects and then maximizing shareholders' wealth. A firm with less capital than profitable projects should be taken, or the combination that it could afford, that gives the greatest NPV. So again, this is like when you have different projects, you will take a mix, but you will also consider the money that you have. So let's move ahead and look at the sensitivity analysis, scenario analysis, and Monte Carlo simulation. Sensitivity analysis involves changing an input variable to see how sensitive the dependent variable to the input variable. For example, if varying sales, we could determine how sensitive is projected NPV to the change in sales, assuming all other factors are constant. The key to the sensitivity analysis is to change only one thing at a time. While sensitive analysis, we start with base case scenario. Base case would be NPV determined by using project input estimate. Now if we change our selected variables by fixed percent points, then we'll see that NPV will move up and down. Then we have the scenario analysis. Is a risk technique that considers both sensitivity of some key output variables to change in key input variables and the likely probability distribution of these variables. The key difference between scenario analysis and sensitivity analysis is that scenarios analysis allows for change in multiple input variables. In scenario analysis, we study different possible scenarios such as worst case, best case, and base case. A scenario analysis for the Fernand Capital budgeting projects is shown in figure 4. Notice that there is a worst case scenario unit here. So if we look at this figure where we have the worst case, base case, and the best case, and the NPVs for all, and the probabilities. So the probability should of all the cases should sum to 1, because those are the only cases that are possible. And then we have the simulation analysis on Monte Carlo, which results in probability distribution of the NPV outcome rather than just a limited outcome. Now let's look at the discount rate based on market risk method. So we use the CAPM, where risk is separated into systematic and unsystematic components. Unsystematic or the company specific risk can be diversified away, while systematic on market risk cannot be diversified away. A diversified investor is compensated for taking on systematic risk but not unsystematic risk. If in the capital budgeting context, a beta or a systematic risk measure is appropriate for measuring project or asset when company or the company investors are diversified. Project or asset beta in conjunction with CAPM can be used to determine appropriate discount rate. So R of a project is risk free plus beta of a project into the market risk premium. So we will be looking at beta of the project. So the beta of the project could be given to us, and we could be asked to calculate the return. required rate of return and then use it to calculate the present value. Now, using a projected beta to determine discount rate is important when risk of the project is different from the risk of the overall company. Such project discount rate, project specific discount rate, is also called the hurdle rate. The hurdle rate vary from project to project. Simply using the company's WACC will overstate the required rate of conservative project and will understate the required rate of aggressive project. Now we move to the real, describe the types of real option and evaluate a capital project using real options. So real options allow managers to make decisions that change the value of capital budgeting decisions made today. Real options are similar to financial call and put options that are given to bond holders but not the obligation to make a decision. The difference is that real options are based on real assets rather than financial assets and are contingent on future events. Real options offer managers flexibility that they can increase NPV estimates for individual projects. The time of real options available include timing option, allow company to delay making an invest with the hope of better information in the future. Abandoning the project is similar to put option. They allow managers to abandon project if present value of the incremental cash from exiting exceeds the present value of incremental from continuing project. Expansion options are similar to call option. Expansion options allow a company to make additional investment in project if doing so increases the value. Then we have the flexibility options, give a manager to manager's choice regarding the operational aspect of project. The two main functions are price setting and price flexibility. And then we have the fundamental options, that are projects that are options themselves because the payoffs depend on the price of the underlying assets. So those are the different options that we can have. The idea here is that when you get into something and when you think it's not working, you still have the best idea when to quit based on the NPV. Now there are some common pitfalls that we want to look at, economic value and some other things that will continue in the next video.